Hello everyone, I'm Tyrell Chambers. Thanks for tuning in to the Chambers channel. If you don't mind delicately tapping that like button, smashing the subscribe button, and tapping notifications so you could get some more of this content. This video is a series of videos I plan to do breaking down your credit. People want to know how is it calculated, what are the long-term effects, and how you can fix it as quickly as possible. So I'm going to start today with your credit score, which is one of the most mysterious financial processes out there for you to figure out. A lot of people I talk to think that your credit score is how often you pay your bills. But there's more to it than that. So let's start with the company that generates your credit score, which is the Fair Isaac Corporation, or FICO, where it's more commonly known. Their methodology for scoring is proprietary to them, but we can generally assess how they come up with the score. 35% of your score is your payment history. Do you have a history of paying your bills on time? How many were late? Do you have any collections? Or are you facing bankruptcy? Most people I talk to think that this is the full basis of your credit score. Remember, it's only 35% of it. That's significant, but it's not everything. So if you want to improve your credit score, don't just focus on fixing your payment history. It is very important, of course, but there are other factors too. The next factor is your credit utilization, or how much debt you carry. If you have a lot of debt on your car loan or your mortgage, or you carry a large balance on your credit cards, this could drastically affect your credit utilization. Some debt can be avoided, like if you live in a place where you need to drive, so you have to get a car loan, but keeping your credit card debt low can go a long way. Next is your credit history. Basically, how long have you had your credit? This accounts for about 15% of your credit score, because the longer you've had your credit, the more reliable the information about you appears to lenders. And this is why it'll be very helpful to get your kids started on credit as early as possible. And that's as long as you teach them responsible behavior. And the next factor is new credit. Opening new credit accounts can often result in a hard inquiry, which often can indicate that you are shopping for the best deal on a loan. This can negatively affect your score for a short period of time. New accounts account for about 10% of your credit score. So please, try to keep those hard inquiries to a minimum. Also note that checking your own score counts as a soft inquiry, so it doesn't really affect your credit score as much. Finally, 10% is based on the type of credit you have. If you have a mixture of different types of credit in your background, that can have a favorable impact on your credit score overall. And like I said, these percentages is a rough outline of your credit score. And that's because FICO works with 3 credit bureaus. Those 3 major credit bureaus are Equifax, TransUnion, and Experian. And they all use this information differently. Even further, some lenders use additional factors, like what your income is and how long have you been at the same job. And the goal here isn't to be perfect. There are many reasons why people change their job. And if you get another job offer, you should take it. It's more about building and maintaining stability over the long run. Having a low credit score doesn't just affect whether you're approved or denied on a loan or line of credit. It can also affect your interest on the repayment of that loan. Your interest rates can swing from the low single digits to the mid-teens. And this can make a drastic difference on how much money you're actually spending on the credit card or the car loan. So keep paying attention to that credit score. And here are some things that you can do to help boost your credit score. Review your credit report and report any errors. Nearly 25% of all credit card reports have some sort of derogatory marks that shouldn't be there. So I suggest that you really take hold of your credit report and look for those errors and report them so you can get them removed. Also, keep old credit accounts. They are part of your credit utilization. Even if you're not using them, they still have a good impact on your credit score overall. Reduce your balances on your current credit cards. Try to stay away from the max. At least 75% or lower is good. 25% and lower is even better. Pay your bills on time. If you fall behind, try using slow and steady methods to catch back up. And if you are not behind, keep making those payments. And keep those hard inquiries to a minimum. I know it could be hard, no pun intended. Sometimes they can't be avoided, but don't go around just opening up so many credit cards at once. Open new accounts to boost your available credit, but don't overuse them, because too much debt will impact your credit utilization. Also, don't open new accounts before applying for a big thing like a mortgage. All those new accounts will look like hard inquiries and will lower your short-term score.